So good morning, ladies and gentlemen, distinguished guests and colleagues. As in previous years, my remarks will be in English, and there will be a real-time translation facility for anyone who would like to hear those remarks in Greek. A copy of these remarks will also be placed on the group's website in a few minutes. This is my fifth time to stand in front of our shareholders in general meeting, and it is almost exactly 3 years since I took on the challenge to lead this group through these difficult times. We've made good progress since the eventful days of 2013, and the bank is in a much improved state. But we must also acknowledge that there remains much to do to complete our carefully choreographed step-by-step journey back to full strength, and in time, value. As in previous times, I would like to begin my remarks by assuring you, our shareholders, that the board, the management, and every employee at the bank continue to focus all efforts on rebuilding a financially sound, trusted, and safer organization. Over the past 3 years, the group has been getting steadily stronger, and it is unarguably a financially safer institution today. This visible improvement could not have been achieved without the increasing trust shown to the bank by our customers, nor could it have been achieved without the dedicated service of our frontline and back office staff. We are extremely grateful to our customers, to our supervisors, to our shareholders, and to our employees for their continued support and encouragement on this journey. I would also again like to take this opportunity to thank each of you for bearing with us and for continuing to support us on this journey. We appreciate the trust and, more importantly, your patience with us. This patience is particularly welcome as we, piece by piece, take the necessary and deliberate steps to restore the bank's financial strength and value and, of course, enhance its risk management and control structures. Dr. Ackerman has covered off the meeting's agenda and made some important remarks about the macroeconomic backdrop and indeed the key features of our plans for the future. This morning's primary purpose is to place the 2015 financial statements before our shareholders. But before highlighting the important takeaways of these financial statements, I would like to take the opportunity to briefly reflect on some aspects of the progress during the last 1,000 days since the bank was resolved and recapitalized. The bedrock of any bank is its capital base, the quality of that capital, and understanding the amount and nature of risk that that capital supports. This fundamental principle has been an area of deliberate focus for us at the Bank of Cyprus. The bank maintains a strong level of core capital, or as we call it, CET1. When we began this journey in 2013 with a core capital of just 10.4%, we quickly determined that this needed to be strengthened. We raised €1 billion of new equity from sophisticated international investors in September 2014. As a reminder, that was the largest ever foreign direct investment into Cyprus since the foundation of the state. It was a watershed moment for this bank, and indeed arguably for the country. Raising this equity enabled us to pass the ECB-led comprehensive assessment and validated the bank's viability. Since then, we have maintained core capital levels in excess of 14%, taking into the account of the views of our supervisor at the SSM during their annual evaluation process each year. We view the level of core capital to be sufficient to support the risks inherent on the bank's balance sheet. Our early focus on strengthening the equity in the bank has been critical to improving customer confidence, shareholder confidence, and regulatory confidence in our bank. It has also been extremely important to create the capacity to de-risk the bank's balance sheet, and you will note that the balance sheet is now €8 billion smaller than it was in December 2013. As at the end of June 2016, the bank's core capital stood at 14.4%, a level that compares well with European banks generally. The risk intensity of our capital, measured by comparing the level of risk-weighted assets to the balance sheet size, is also very high by European standards and offers you further evidence of the prudent level of capital against the inherent risk on the bank's balance sheet. Bank of Cyprus has sufficient common equity to support its strategy and is not expecting to raise any additional equity. However, we are, as you should expect, constantly examining ways to improve the efficiency of our shareholders' capital, as well as the funding of our balance sheet. To that end, and as our bank normalises, we are carefully exploring the possibility of introducing Tier 2 capital to augment the strength of our balance sheet and supplement the equity capital base. This is another positive and deliberate action on our recovery plan. The bank's previous strategy of expanding to non-home markets proved unsuccessful. Until recently, the residual risk from these overseas businesses presented significant event risk to the group. Our strategy during the past 1,000 days has been to shrink to strength through deliberately shedding non-core businesses and overseas exposures. We have now substantially reversed the previously adopted strategy and sold businesses and exposures in Russia, the Ukraine, Romania, Serbia, Greece, and elsewhere. We have repatriated this capital and liquidity and refocused management attention onto Cyprus. We have reduced the group's employee numbers by some 4,000 during this period through such sales, and while there is still overseas exposures that we are managing down, there is now no individual exposure that presents an existential risk to the group. We are now focused on building our capability in support of the Cypriot economy and supporting entrepreneurs in the UK through our UK bank. Our strategy is simple and separately focuses on Cyprus and on our much smaller UK operations. Dr. Ackerman has already discussed the world economic backdrop and referenced a strongly recovering Cyprus economy. It is pleasing to see a sustained recovery in Cyprus. It is pleasing to see tourist numbers at record highs, a pickup in industrial production, falling unemployment, stabilising property prices, and continued fiscal discipline in government finances. There are certainly encouraging signs that make us cautiously optimistic about the prospects for our core Cyprus market, and through the momentum of policy reforms do need to continue. As the government emphasises, there is still unfinished business on that agenda. But of course, there are also real fragilities in Cyprus, and they express themselves on the banking system's balance sheet. Non-performance and delinquency continues to be a scourge in our loan book and a stain on the nation's image abroad. The bank has made some good progress in reducing the level of problem loans, but the sheer size of this problem created by the events of March 2013 and, importantly, the preceding excesses mean that this problem will be with us for some years. We have reduced the quantum of delinquency in our balance sheet, but it remains still unacceptably high in a European and developed market context. We continue to need the support of the legislature, the legal system and wider society to speed up the resolution of this issue. We will, of course, continue to ensure we play our part in protecting vulnerable groups in society. We will also actively seek to find innovative solutions that bring bank loan servicing obligations more in line with the changing economic and financial circumstances of cooperating bank borrowers. But we will also be tireless in the pursuit of strategic and other defaulted borrowers more generally. In early 2014, we reorganized the bank to specifically separate the management of delinquency from the mainstream bank. This deliberate separation stabilized the problem and allowed us to focus explicitly on creating viable remediation. This strategy is now delivering for us. We have been able to reduce the stock of non-performing loans in each of the last 5 reported quarters. We have embedded essential routines and protocols across the various segments of our business to create viable and enduring solutions to our customers' problems. During the period January 2015 to June 2016, we have been responsible for approximately 2/3 of the reduction in non-performing loans in Cyprus as a whole, despite the fact that we only have a 40% market share. There is still, however, much more to do. In late 2015, we recognised that the foreclosure regime newly implemented would encourage an increased level of consensual asset transfer from troubled borrowers. We established a real estate management unit, we call it REMU, to professionalise the onboarding, management and sale of foreclosed-on properties. We created a formal joint venture with Resolute Asset Management, and we are pleased with the focus that this has brought to this area. We believe this initiative will help accelerate the recovery process of Cyprus and the bank, as well as help further professionalise the Cyprus real estate market. This continues to be an area of very deliberate focus for the management over the coming years. The fundamental lubricant to a functioning banking system is confidence. The events of March 2013 did serious damage to customer confidence in the Cypriot banking system, and more specifically, in the Bank of Cyprus. We knew that words could not repair the damage, and as I mentioned earlier, we set out to rebuild that confidence through concrete actions, not words. We tackled the problem piece by piece. We raised capital. We restructured the way we ran the bank. We sold overseas businesses. We released trapped fixed deposits early. We worked with the government to lift domestic and international capital controls early. We focused on doing real things. These deliberate and real building blocks have had the combined effect of slowly creating confidence for our customers to again place deposits with the bank. Deposit erosion was halted, and we have begun to be able to grow our market share in both resident and non-resident deposits since the abolition of capital controls. Today we have a 28.6% market share in resident deposits and a 33.8% share in non-resident deposits. We are extremely grateful to our customers for their renewed trust in the bank, and we are determined to sustain and strengthen that trust on a daily basis. The combination of corporate finance actions, repayment of government bonds, balance sheet shrinkage and deposit growth has meant that we have been able to repay more than 10 billion of emergency liquidity assistance funding from the highs in April 2013 of 11.4 billion. And we are today less than 1 billion in that funding number. We hold more liquid assets than we are reliant on ELA. The repayment of ELA demonstrates that the strategy we set has to date worked to restore and normalise the bank's funding profile. Our loan-to-deposit ratio is now on the right side of European averages. The progress in repaying ELA, normalising funding and maintaining capital sufficiency against the clear objectives we set has been recognised by international credit rating agencies. Both Fitch and Moody's have upgraded our credit ratings repeatedly, and we are hopeful and confident of further upgrades in the years to come. We continue to work towards an investment-grade rating, however, that is still far away. We also recognise that fixing the financial underpinnings of our bank is only part of the story. Our industry globally and our predecessor banks in Cyprus lost the trust of society. We recognise the need to embed a customer-centric, transparent and non-bureaucratic, modern, humble and honest set of values that should pervade the organisation and should be on display across our business. Changing the culture of any organisation takes time, but we are committed to doing so. We are embarking on significant changes to our processes, to the level of digitisation, to our culture, which is at the core of the bank. We know that we have still much more to do to progress this agenda, and we know that we still have much progress to make in developing a truly customer-centric culture that puts customer service and modern business practices at the heart of everything we do. We have a truly world-class board. We have adopted the highest standards of governance and protocols. We will also facilitate our attempt to move the group's listing to a large liquid European exchange by maintaining this level of governance. We are committed to flag carry our brand and the country's image onto the world's largest financial markets. We are committed to the highest standards of governance and business practices as part of the cultural transformation of this business. We have reinforced in the group a culture of accountability and learning. We are engendering a culture of self-identifying and fixing shortcomings, but we also recognise that this is work in progress. The main purpose of today's AGM is to table the financial statements for 2015 before our shareholders. It already feels like a long time ago, 2015, and indeed it is the middle period of the journey that I've just talked about. I'd like to make a few specific remarks and observations on the 2015 financial statements before you today. The bank posted 3 profitable quarters in 2015, but taking into account an important and continuing regulatory dialogue, we posted a 630 million impairment charge in the 4th quarter of 2015. This charge was taken following certain changes in the assumptions used in the bank's provisioning methodology, all within the parameters of IFRS, taking into account the bank's strategy with respect to its non-performing loan portfolio, taking into account developments both at a macro level in Cyprus as well as specific developments in various borrower exposures, and importantly taking into account the regulatory dialogue between the bank and the ECB regarding what's called SREP, which is the annual evaluation process in 2015. We believe that the amendments to our methodology significantly bridged the regulatory dialogue and have in any case resulted in an increased level of conservatism within an acceptable range in our provisioning calculations. We explained this at the time, we posted the charge, and as a matter of practice, we continue to direct our pre-provision profitability to de-risk our balance sheet. As a result of posting the elevated Q4 charge, the outcome for the full year was a loss attributable to shareholders of 438 million euros. As at December 2015, the bank's capital ratio was at 14%, despite taking a full-year provision charge of 959 million euros. 2015 was the first year where we recorded material reductions in problem loans. We made material progress in this regard in the 3rd and 4th quarters, with accounts overdue more than 90 days or having impairment being reduced by 649 million and 668 million respectively in each of those quarters. A reduction of 1.3 billion was posted for the full year 2015, and the trend established in the second half of 2015 continued and accelerated into 2016. In April 2015, all international capital controls were lifted. This was the first real test of the resilience of the bank's deposit base. We are pleased to note that in 2015, in aggregate for the group, the deposits grew by 12% or 1.6 billion after adjusting for the disposal of our Russian business, Uniastrum. And this was achieved despite the full lifting of all capital controls. In 2015, we completed the disposal of our largest overseas banking subsidiary, Uniastrum, in Russia. This represented an important milestone for the group and significantly reduced our operational risk profile. Using the proceeds from deleveraging, deposit inflows and more normal ECB monetary operations, we repaid a further 3.6 billion of emergency liquidity assistance funding during 2015. The balance at the end of 2015 was 3.8 billion, and as a reminder today, the balance has gone below 1 billion euros. We previously presented the bank's results for the first 6 months of the year to the market, and we will announce the 9 months numbers on the 14th of November. But I'd like to take this opportunity, having you in front of me, to remind our shareholders that progress during the first 6 months of 2016 has been incrementally positive. We also expect to report continued positive progress in Q3. I'd highlight a few points. The bank posted an after-tax profit of 56 million for the first 6 months of the year. At June, our Common Equity Tier 1 ratio, our capital ratio, was 14.4%. Deposits in the first half of the year grew by 566 million, or 4%. Our market share was at 28.6% in resident deposits and 33.8% in non-resident deposits at the end of August. We further paid down significant amounts of ELA, and as I am continuing to mention, we now carry more liquid assets than we do ELA. The near-term prospect for eliminating this is now very real. We made good progress in problem loans. Exposures with arrears greater than 90 days or with impairment fell by 18%, or 2 billion euros during the first 6 months of 2016. We continue to direct our operating profit to de-risk the balance sheet, and coverage levels against the balance sheet risk continue to rise. Exposures with arrears greater than 90 days, or indeed impaired, have provisions in excess of 53%, and these exposures are more than 100% covered when the discounted value of collateral is included. During the first half of 2016, we also took the very painful but essential step of further reducing staff numbers in Cyprus. We ran voluntary retirement schemes, and this resulted in 432 people leaving this group. This should result in a 22 million annual cost saving and will help stave off the competitive pressures and headwinds that exist in our business. It is, of course, a difficult and disruptive process for the business to go through, and as always, we do regret the personal discomfort that such processes cause our employees. Turning to our priorities, we have achieved a great deal in the 1,000 days post the resolution of the bank in 2013. But there remains much to do in rebuilding the value and position of this institution. I remain hopeful that the track record of delivery that we have built during this period will provide our customers and all stakeholders with the confidence and renewed patience to continue to support and encourage us as we complete this journey. We remain committed to the same strategy. We want to serve our customers better through improved branch service, better technology, reduced bureaucracy, and consistently raising our standards. We have made progress in these areas since the last AGM, but not enough of these improvements are visible to our customers. We will continue to play our part in the recovery of the Cypriot economy. We are pleased to be supporting the real economy with more than 650 million of new lending so far this year. We are pleased to be supporting some of the new developments and new projects coming to Cyprus with the aid of overseas capital. We will stay focused on making the bank safer, on managing risk, on repaying ELA, on restoring customer confidence and investor confidence in the bank. We will vigorously and deliberately pursue the highest standards of corporate governance and do all we can to discover liquidity and value for our bank and its shareholders. As Dr. Ackerman mentioned in his remarks, work continues on our efforts to prepare the group for a London listing, and we are continuing to engage with all stakeholders in this complex multi-jurisdictional project. The timing of any potential listing continues to be uncertain. We will make announcements on plans and progress as soon as we have greater clarity in due course. While we are pleased with the progress we are making in tackling delinquent loans, the problem remains very large. We will continue to devote huge effort in driving momentum and resolution to this societal problem. We will continue to encourage government and legislators to put in place essential reforms to allow us more rapidly resolve this last big hurdle to declaring some level of closure on the most serious financial crisis that Cyprus has had to cope with in recent years. Ladies and gentlemen, distinguished guests, 1,000 days into this journey, there is no question that the bank is in better shape. 2015 was another year that strengthened our foundations, and in the first half of 2016, we made further significant progress. But we still have a lot to do before we can declare any form of victory. We have to get Cypriot society behind us in making loan delinquency an unacceptable societal issue. We must, of course, protect the vulnerable. That goes without saying. We must continue to earn our customers' trust and respect. We must continue to battle all the issues across the group with the same intensity and determination as before. And, of course, we must deliver on our promises. Last year, I said I thought our long-term outlook was bright. I'm even more convinced of that today. We are confident of the group's prospects and in our ability to deliver sustainable returns to our shareholders, you. I would like to thank the people of Cyprus, our customers, for continuing to make me feel so welcome in their country. I would continue to pay tribute to the Cypriot authorities, particularly the Ministry of Finance and the Central Bank, for their continued attention to the long-term interests of this country. I'm extremely humbled by the continued dedication to duty of my colleagues across the group and their commitment to success. I know we share a common determination to deliver a better bank to our customers and a more valuable one to our shareholders. Ladies and gentlemen, thank you for your attention.